Hi, I'm Michael Engelbrecht. I'd like to ask you a question. I was with a group of 8 other pilots the other night, and I threw it out to all of us. Nobody had an idea at all about the numbers we're talking about. I said, how much money of shares outstanding does Delta have out there? If you were to buy all the stock back, how much money would it be? Because it seems to me like when you're buying $5.5 billion worth of stock back, eventually you will have bought it all back. And nobody knew the answer to any of that. We had no idea how much stock we have outstanding, when you could hit that. Once we buy it back, do we turn right back around the next day and sell $5.5 billion back? Nobody had any idea about that. Could you address that, please?
So, Greg, what is the market capitalization now?
I don't know what the total market capitalization is. I just knew that.
Okay, yeah, I don't have that. It's easy to look up. You can just go on Yahoo or anywhere, and you can just. Okay, good. Okay, thank you. So, okay, the idea is not to buy all the stock back. It's to boost the stock price, and now it will shrink the outstanding stock base over time, and if you keep doing it persistently enough, you'll actually show your earnings per share are going up only because your shares are being reduced. The denominator is being reduced. Of course, at some point, the earnings might decline. Now, Delta, we'll see what they continue to do in the future. If they get persistent enough in doing this, they're not going to buy back all the shares, but they're going to shrink the outstanding base. And then the question is, what, quite apart from what they aren't doing, or not really quite apart from it, but they could be using the money in other ways. Those other ways are going to be the kind of investments that are going to generate earnings in the future. At some point, I would predict, if they keep doing that persistently, their earnings are inevitably going to fall. And they might not just fall because of a computer crash. They might fall because they can't deliver the service, and there's other competitors who can. So that's, obviously, this industry well, much better than I do, but it's not an industry where you don't have capital expenditures to make. It's one where you need that money. So it's even more so a waste of money. It's an industry where there's plenty of things in which you need to invest in all the time.
If their stated goal is to keep the stock price up, wouldn't it be a better way to do a reverse split and just take stocks out of the market by doing a 2-for-1 reverse split?
Well, yeah. See, they don't actually say. I mean, a split isn't going to really change the stock price, but they don't actually say, looking at, annual reports, proxy statements, that they're trying to get the stock price up. They call it their, I think, a capital return program. Apple calls it the shareholder return campaign. So I'll just give you the example because I know the numbers quite clearly there. In the case of Apple, the only time Apple ever got money from the public stock market was in 1980 when it did its IPO, got $90 million in its IPO. Anybody who happens to be still holding Apple stock, who's held it since 1980, would not want everybody else who's coming in and out to get the benefit of stock buybacks. They want the company to continue to retain and reinvest. Okay, so there it's clear who you're returning money to. You can't return something to someone who never gave you any money. When Carl Icahn got involved with Apple, he did not one penny of what he put into Apple shares went to Apple. It just went into outstanding shares. Now, in the case of Delta, as I understand it, I think even the pension got some shares. The debtors got shares, so they were lucky to get something, and they got shares. And now they're getting, if they've held those shares, I haven't looked at the numbers, but I'm sure they're getting a really, really good return out of having lent money to a company that went bankrupt. So why would you want to give them an extra return by boosting the stock price? Or why do you call it a capital return program? They already gave you the money. You went bankrupt. They had to take the shares. There was no new infusion of cash at that time from those entities. You could have had a settlement where they got nothing. So you're not returning them. So ask the CEOs why they're doing this. And they're not going to say we're doing this to give temporary boost to our stock price. They're going to say something else. They're going to say, well, the shareholders are the people who invest in the company, and we have to give the money back, or they want to invest in our company, and then you can point out that that's just not true. There's the workers and taxpayers who invest in the company much more than shareholders, and the shareholders don't invest in companies. If I go buy shares in a company, I'm not investing in the company, and I'm a fool if I think I am. All I'm doing is buying shares and hoping that I'll get a dividend yield on them, maybe a capital gain if I'm being more speculative, and I can very low cost get in and out, limited liability. I'm not investing in the company. I don't have, and actually you wouldn't have a stock market if everybody had to know what was going on in companies before they put their money in. That's the whole point of the stock market. It's liquid. You can get in and out. So it's not what the stock market is about, investing in companies. That's why I even object to when you call it institutional investors or the investors, because you think that they're investing in the company. This is where you get into the issue of language. If you think that those are the investors in the company, they're not. They're actually the least of the investors in the company. And people put their effort and skill into building up a company, get paid now, but with a view to being a part of this success in the future and having a career and a retirement. You're investors. Those workers are investors, and we want all workers to be investors. We don't want workers who are just being paid for the work they do today, and companies don't want those kind of workers. That wouldn't make a company great. So people have to really rethink about the whole issue about what the stock market is and what's going on there. But in answer to your question, they actually don't. Other than just say we're maximizing shareholder value or capital return, there's just these mantras thrown out without any real justification. The only justification you can sometimes see in a high-tech company is the one I said about, which I'll put in the financial statements, is that we have to offset dilution because of the exercise of stock. And I've argued there's no good economic reason for that. Then don't give them stock-based pay if that's what you have to do. If the cost of it is doing stock buybacks to make sure they get the gains, that's just pay them in cash. Pay them in promotions, pay them for being creative, whatever. Don't outsource your pay to the stock market, which is a lousy way actually to pay people anyway.
Bill, if you want to know the numbers, we came out of bankruptcy with 850 million shares outstanding. They're down to 730 million now, so they've bought back about 120 million shares just for
Great, yeah.
Just for clarification.
Yeah.
The dividend and buyback, is the dividend and buyback money ever related by percentage tied to any earning metric?
Okay. So here's the thing about dividends. If you look at the history of dividend payments among major companies in the United States, first of all, going back to when really a stock market, industrial securities emerged, which was just really the late 19th, early 20th century in the United States after the great merger movement in the 1890s, most of the shares were preferred shares. So, and that's kind of in between a common share and a bond. So the company then has to pay out, if it's a 5% preferred and they make profits, they have to pay out the 5%. If they can only pay out 4%, you might have a cumulative preferred, which means the next year if they make 6% or more, they have to pay the 1% they missed this year or whatever. So, okay, that was a way in which originally when money was being put on the stock market, you could have some guarantee of a dividend. That disappeared in the 1920s when the corporate structure became much more stable. You have an oligopoly structure, and people started. It's still what I told you about the blue chip stocks. You still didn't know what was going to happen to General Motors or General Electric, but people started putting your money into those companies, and they would put their money into into the shares of those companies and common shares. So there's no guarantee of a dividend. And I think if you look at corporate finance teaching that went on from that time until the 1980s. It was really, well, you pay dividends if there's money left over once you have to do everything else. Okay. What happened in the 1980s is, well, first of all, under those conditions, however, what people found, the studies found, was that companies didn't like to cut the dividend. I think they didn't like to cut the dividend because they liked the stable shareholder. They didn't executives back then in the 50s, 60s, they liked shareholders who would be stable shareholders, not make demands on them. They could run the company, and so they kept them happy by paying them keeping the dividend the same dollar level per share, and that would be one sign of their ability to deliver. But another sign was you kept people employed. You grew revenues. You grew profits. Okay. Once you got into the 1980s, and part of the whole notion of maximizing shareholder value, something you can find in almost every financial statement now, is a very insidious phrase, free cash flow. Because the issue is, what is free? And if laying off 10,000 workers, if the company is free, the cash flow that's released by that is free to pay out in buybacks or dividends, well, we got a problem. And that's basically, you look at what's being taught in business schools, they'll say, it's your necessary capital expenditures and plant and equipment. So it's a foolish view of the business enterprise. And I can't even start to say the idiocy that comes out of the economics profession and out of business schools, not out of all people in business schools, but out of the finance part of business schools about how you run a company. And it's partly because they're really all talking, even when they don't mean to, about taking money out of the company rather than putting money into the company. And so dividends in a well-run company should be something that you pay when you can afford to pay dividends and remain competitive in the future. And remaining competitive in the future doesn't mean just producing the products you're producing today. It means investing in new products that can be competitive in the future, because we have a world of competition out there, and that's how you remain competitive. And dividends themselves should be what you pay when they're left over, never mind buybacks. But now these have become kind of a right. These are the first thing you pay, and you find the so-called free cash flow in order to pay them.
You got another question?
Yeah, I just, for the audience here, the question that I had asked you over the break so that you could explain it to them, the question that I had was, because our pension our defined benefits pension is currently a liability, would it have been a better utilization of the cash to pay off or to make our defined benefits fully funded versus the stock buybacks? Would that have been a better utilization of our cash resources as opposed to evaporating the cash via the buybacks?
Well, that makes sense to me. Ellen, do you have any comment on that? Yeah.
If they put money into the plan, it brings the liability down, which immediately would generate income. And they're also using an expected return, often higher than the market return, so that when the money, let's say you put $100 million in, they use an expected return of 8% perhaps. It doesn't matter what the money earns. They're going to get 8% automatically guaranteed. And that will go it'll be part of the mixture of the benefit cost that affects earnings. So it's an immediate gain for the company to do that, to put the money in. And it's a gain going forward as well.
Yeah. And the other side of that, when they spend it on buybacks, they're just, if your pension is underfunded, you're putting yourself in a bigger hole. And,
Internet question from Sol Castal. He asks, how do buybacks affect earnings? Are earnings manipulated by buybacks?
Okay, well, earnings per share is manipulated by buybacks. So, for example, I'll give one example. We looked at McDonald's, which up to a year ago, for the previous 10 years, had done $3 billion in buybacks every year. Actually, we looked at it because the Service Employees International Union was one of the first unions to get interest. I think the first union to really get interest in the buyback question, seeing that this was a problem, not just for the low-wage employees they were trying to organize, but for the franchisees and for seeing some point of common alliance with the franchisees against the corporate office, get rid of the buybacks. And so McDonald's have been doing this about $3 billion a year, and their earnings per share, you just see it going up, and their revenues start coming down. Of course, the revenues come down enough, they're going to erode that increase in earnings per share by doing the buybacks, reducing the amount of shares outstanding. Then, interestingly enough, there was demonstrations. This was a year ago, last May, at their annual meeting of shareholders, and including by the unions, and some of the union members were chanting "No more buybacks," which I thought was great. I had never heard that before. And what did McDonald's announce? Their turnaround plan. And the turnaround plan, they was going to, serve breakfast all day and stuff like this. But one of the key things was they're going to increase their buyback program from $3 billion to $6 billion, and if they could afford to $9 billion. And I think they did $6 billion. So it's just they're not even thinking about earnings. They're thinking about getting that stock price up.
Another question. How do we create the concept that CEOs should be paid for the jobs they create?
Well, that's a good one. Yeah. I think that would be great. I wouldn't say create, or you might say the jobs they sustain. Who actually creates the jobs. I mean, a lot of emphasis is out there on the entrepreneurs, and entrepreneurs are really important in the economy. And entrepreneurs do pretty well, particularly if they can do a stock market listing. There's a lot of risk with entrepreneurship, and I have no problem with the notion that someone starts a company and they put a lot into it. They're taking on a lot of risk. On the other hand, people who want to be entrepreneurs love being entrepreneurs, and it's a challenge, and unfortunately a lot of people can accomplish this. However, once a company starts getting to a certain size, you still need to have kind of some entrepreneurial view of the future, but it needs to be managed. And at that point, I don't think it's so much creating jobs as sustaining jobs. And sustaining the jobs that will allow people to be creative to create the products that make the company successful. So I don't want to put too much emphasis on just once you get a company going and you have a collectivity of people there working together. I call it a collective and cumulative process. That you put too much emphasis on any one person as being the creator of all this. I think it really needs to be seen as a collective process by that group with some leaders. And I think people should get rewarded for that leadership. And maybe differently when they're a small company that's become successful as an entrepreneur, a large company that is successful in remaining large. Now, one of the problems of CEO pay is, in fact, the Silicon Valley model. What happened is that there's a whole history of executive pay, which I won't even start going into, but essentially, executives tried to get stock options. They did get them between 1950 and 1976 as a tax dodge. They got capital gains tax rate on stock options, and then Congress got rid of that. They said, no, you can't give a special privilege to these executives. They're employees like other employees. Okay. Then the Silicon Valley model came along. And really important in changing tax laws, changing a whole lot of things in the late 1970s, before Reagan started, with Reaganomics getting tax rates down, was the National Venture Capital Association and the American Electronics Association coming out of Silicon Valley saying, we're starting these risky companies and we need lower tax rates. Okay, one of the ways in which they got, the key way in which they got people to work for those companies was stock-based pay. Okay, now, so if you were in Silicon Valley, Hewlett-Packard was an old economy company that right until the 1990s never laid anybody off involuntarily, what's called the HP way. Then they changed quite a bit when Carly Fiorina came in there. Other companies that were starting up, if they wanted to get people to leave secure employment, even with HP, never mind IBM and other companies, they were offering stock options because a startup couldn't say, oh, we're going to give you a defined benefit pension. You had it only could happen when the company had been around a long time, and you could be clear that it was going to be around a long time. So that's where the origins of all the stock-based pay came from. It didn't come so much from the CEOs. At the same time, what made that whole model possible was not just stock-based pay for the employees, but the creation of NASDAQ in 1971, which was a speculative stock market on which you could list very easily. That made venture capital possible, and it also made that stock-based pay possible because you could say to the employees, you know, you come to a startup and we can do an IPO in 3 or 4 years. Impossible to do that on the New York Stock Exchange before that. Okay, so that then ends up driving stock-based pay, and it actually becomes interesting because it then, that stock-based pay and the stock market becomes tied up with being innovative. Okay, then you start having someone go on the stock market and making a huge amount of money with a small company, and maybe it's a really innovative company. Sometimes you make a huge amount of money with companies aren't innovative, but maybe it was innovative. And there you have a CEO of a big company with 200, 300, 400,000 people, and they're saying, hey, you know, I should get paid like them. So they start creating this demand for stock-based pay. But it actually came in through this broad-based pay in the Silicon Valley model. It's a very important part of it, and it's one of the reasons it's actually out of control. Because once those companies got big, Microsoft would stop stock options in 2003, but gives out stock awards. But it went crazy with stock options. I mean, it just crazy with giving out stock options. And it actually turned out to be very counterproductive because in a boom of 1999, 2000, too many people left Microsoft. They destroyed their innovation process. Bill Gates knows that. So it has to do with the whole system. You know, it has to do with the whole set of norms, the whole set of institutions. It's not just some people are, you know, and people make out within that system and they work within this system. And that's what's so difficult about it. But there are ways you can, you know, which I gave at the end of my talk, in which you can cut into the system. And you can say, hey, there's something wrong with the system and this is where it is. And it's around not just buybacks, it's around the whole way in which the stock market operates and the whole ideology of the stock market. And if we're going to have all our savings in the stock market, we better figure out how the stock market works, or some people are going to gain while we lose. And you know that.
You mentioned earlier about trying to get rid of 10b-18 and the Security Exchange is supposed to check for manipulation. Has anybody done any study about volume sales prior to these buybacks to sort of show, hey, there's a strong correlation between an uptick in volume and obviously the buyback, and saying they're too close together not to be a strong correlation that manipulation's going on? Has anybody done any kind of research there?
Okay, so there's some problems. One is that we don't know when they actually do the buybacks. We don't know the days on which they do them. We know after the fact, we know the month in which they do them, and since 2004 we know this. They're required to report it and the average weighted price. But there's too much going on in the market, and particularly in a market where a lot of the players, I mean, we now have high-speed, trading, and that a lot of people say that's about half the volume of the stock market. So you're going to have to factor in a lot of stuff that's going on around a company's stock price to be able to figure it out. And no one in general has been very good at explaining stock prices. I'm not saying it's not worth doing, and I've thought of various ways to do it. In terms of research I do, it's really a matter of where you're going to put resources. And I find it more useful just to look at what happens to companies over time when they start getting involved in these practices. So I could go on and on about that. And so I kind of see that's the way of building up the evidence rather than trying to figure it out statistically at an aggregate level what's going on.
Bill, if a company puts $5 billion into the pension plan, I misspoke slightly before, that improves the funding status because the assets are higher, so yeah, there's less of a gap. That money, the income on that money flows into earnings, unlike income on the sidelines, which are taxed, et cetera. They have to sell the stock to get a gain and then pay tax on it. Companies that are well funded for years have lobbied heavily in Congress to get the funding limits raised. They would like there to be no funding limits because that's a wonderful place to put their money. They love to put as much money as they can into the pension plan. So why would a company not want to do that? Obviously, they have no cash, they can't do it. But why would a company not do that?
I don't know. So they have to be asked, why are you mismanaging your company? No, I think, I was asked this question also at the break. I mean, now that this research of mine has gotten some visibility, because that's executives read Harvard Business Review, there were I would have thought, well, there'd be lots of letters to the editor at Harvard Business Review saying, he doesn't understand what he's talking about. I haven't seen that. I'd like to see what the defense is. I've seen a few consultants, one who said, oh, it all goes into venture capital. I think that's a hard argument to make. I think venture capital has always had more than enough money than good things to invest in. Arguments like that, it just goes back through the stock market and gets the best alternative use. Well, where do these uses come from? It doesn't come from out of the air. It comes from people forming companies and growing the companies. Okay, but I really would like to see not just some defense of this rather than just throw at the ideology about that this is good management. But also, you saw that thing of the monthly buybacks of Delta. Who's thinking those things up? What are they even thinking about? What's the algorithm they use, or what's the calculus, or whatever? I actually don't know. I haven't seen that, publicly discussed. Those would be interesting, given how widespread this phenomenon is. We should know about those things. And so I think pushing this issue is at a minimum, starting raising questions about what good management is, and there's all kinds of ways, including the pensions, in which you can invest in the company and make the company stronger than it was before, rather than inherently making the company weaker by giving people incentives to sell your stock, including the top executives.
I think we're going to have to shut it down at that point. And once again, thanks to Dr. Lazonick. Alan, appreciate it.